Hello and welcome to the Dorsey Report. You can always read more at Google Sites, my stock twits, or Twitter. Today's report is for February 9th, and we'll look at last week's action, how the markets seem to be loving how central banks are taking it easy, and relative assets, how they're responded, how we're really in a global ticking debt bomb situation. More details on that from a McKinsey report. Taking a look at global valuations, how U.S. returns are really not competitive based on some standard valuation metrics, looking at some additional global risk metrics, and for our premium subscribers, C-suite status and an S&P chart analysis and forecast. And as always, if you like what you see here, please like, share, and subscribe to my channel. Thanks. So we had an amazing rally over 3% in the US markets. Right here on the Dow, we see just how amazing this move was. Basically a quick test of the 200-day moving average, big bounce, starting off with an Australian rate cut, then a Chinese rate cut. Then Fed Speaker Coach Lakota came in with hints of restarting US QE already, and Denmark came in with a rate cut. And meanwhile, we have strong payrolls. So that's kind of the big if right now. The big question mark is with all this strong economic data coming in the U.S., how long the Feds can continue to be murky about when they're going to start ramping actual interest rates, if they're going to come in at the sort of June-July expectation, or possibly start coming forward a little bit more towards the original April target. So we'll see about that. As far as how actual assets performed here, we see that on the month, the previously weak oil explorers, Russian markets, Apple, Disney have all really popped quite a bit, which would typically be an inflationary signal. We've got gold miners as well as our core energy producers all doing very well. So it looks like based on sector rotation, you're seeing basically basic materials are doing very well here. So that could be a sign that we've entered a new bull market rally. But if you look at the performance on the week, we're seeing the weakest performers right now are actually all the very interest rate sensitive sectors, notably U.S. long bonds, utilities, real estate, corporate bonds, and the dollar. So there's something going on that suddenly made bond markets essentially turn around, and anything sensitive to those interest rates starting to rise now, which is an important macroeconomic signal that we don't want to discount. We can see here on the utilities chart, big turn, big break below the major moving averages. RSI is well below 50 here, so definitely in shortable territory. Interesting thing about the utilities sector is the highs actually lead broader market action. We've got the S&P 500 here in black by somewhere in the range of about 20 trading days, about a one trading month. We see there we had a nice little lead there. This is about the shortest lead, 10 days. We had another lead over here of about 20. And then we've had our latest lead over here, a little bit shorter, about 16. But that's telling us that since we had a peak here just last week before the big sell-off, we've got maybe another 13 trading days before we see another significant peak in the risk markets, followed by a pullback. So we'll see if that one actually pans out, but that XLU lead on the highs is definitely significant. McKinsey, big analytical agency, just came out with an interesting report about global debt growth, and just a really sort of revealing figure about how even though GDP has basically recovered and grown, it's been on the back of debt essentially to the tune of $57 trillion increase since the last global economic peak. And when you look at how much as a percentage of global GDP, it's actually risen from 269% to 286%. So it looks like basically every dollar of GDP growth that we've had has actually cost more than $1 worth of debt growth. And specifically in some of these countries that we've seen, Japan has been a basket case on the debt side of things for decades now. But we've seen Spain, specifically Spanish banks, in the news quite a bit. China's had its whole shadow banking leveraging going on. And then also in the U.S., we see is pulling up at a very significant, almost 270% of GDP in debt. And as far as the constituent parties, that's even more revealing. We see this big increase here, but as far as the biggest parties to grow during this latest debt binge have been households, a 7 trillion increase. And as far as the compound annual growth rate, that's been cruising at 3%, so not so bad on the household side, whereas governments have seen a fairly large increase. What's that, over 25 trillion? But the compound annual growth rate since 2000 has been over 9%. So I'll invite you to draw your attention to what else was growing at over 9% between 2000 and 2007 before the financial crisis. Yes, that's right, it was the financial sector putting in the rate that now sovereign governments are putting in the 7 years following that. So basically debt has shifted from the financial sector, where it blew them up almost 7 years ago, to government balance sheets, sovereign balance sheets, and chances are it's going to blow them up as well, because that's a completely unsustainable rate of debt growth. So why does this all matter? Well, it matters because according to the legend himself, Warren Buffett, and many other very fundamentally based investors that are just looking at macroeconomic factors and buying into asset classes when they show basically characteristics that are attractive over generations, not even decades or years or, God forbid, financial quarters. But the key, there's three key long-term metrics that these guys are looking at. And what do you know? Number one is interest rates. And basically the way he puts it is they act as gravity. The higher the rate, the greater the downward pull on other assets. And effectively, if the rate on government debt has to rise, then the prices of all other assets, investments, must adjust downward to bring the rates of return into line. And so what we've seen since the financial crisis, built on and the recovery since, built on the back of amazing amounts of debt added to public balance sheets, is that interest rates have fallen, mostly because of central bank policy. But we're in a historically low, even negative in the case of Europe, market interest rate environment, which has conversely pushed up the price of all other investments, well, most other investments, but specifically stocks and U.S. stocks. However, when that coin finally flips, as we actually started to see last week with yields beginning to rise, as those rates rise and normalize back at their, say, 4+% for U.S. 10 years, that is going to push down the prices of all their assets. And in fact, if we look at another interesting metric, total market cap as a relative to GDP, so GDP being the denominator, we typically see rates that don't get much higher than 100% before they eventually pull back. We had the huge tech bubble, which didn't even hit 150%. 2007, we didn't even make it. We made it to about 111%, and now we're at 123%. And so the market basically has a much larger share than the actual underlying economy. And if we look at the expected returns as a function of that, within these bands here, the green band being sort of 40%, so stocks are attractively valued, and 120% being the upper limit, stocks being overly valued, we see that the actual returns are tracking that median fairly well. And because we can project this out in the future, we can see that this is actually dropping well off down to basically a 1% expected return over the foreseeable future. And if we back out here and make this calculation across several different markets, we can see that, well, the USA and, what do you know, another debt-laden country, Japan, and Germany, who's ultimately backing the entire European project, And what do you know? We see Switzerland in the list as well because of all the debt they've taken on to maintain that peg. Essentially, these countries have very low expected returns because equities have become extremely overvalued. Um, However, some other countries may look attractive. Singapore, Australia, and interestingly, one of the markets that I've been pointing toward, Russia, has a very high expected future return. So definitely take a look at Guru Focus, some interesting tools there in terms of just straight up market valuations. Some sentiment analysts, notably Jason Gupford at Sentiment Trader, are also confirming that there's low expected returns in the U.S. equity markets futures, saying that prior occurrences of excessive confidence, essentially that we've seen in the late 70s, 2000 and 2007, all basically led to S&P returns of negative 5% versus a 9.5% average over one-year periods during other periods. So we're definitely in a sentiment situation which agrees with the fundamental analysis that U.S. expected returns are zero, if not negative, for some time over the next year or two. And another look at those analogs, we're looking at the Wilshire, basically the global composite for equities over U.S. long bonds. And we see that in both 2000 and mid-2007, we saw peaks that had a 2 to 3 month lead on the markets. Actually, in 2011, during the whole debt ceiling debate, we also saw that happen. However, what do you know? We're definitely rolling over on that indicator. So I think it's really only a matter of time before U.S. markets see some serious selling. Also, Wilshire over the US dollar is a coincident indicator for risk, and that has definitely peaked out and is pulling back, definitely breaking down below any potential channel line. So be on your guard if you're a longer term investor, because it looks like US equities have seen their upside. And we'll wrap it up with a quick shot at the China 7-day rate, continuing to make higher highs on a short-term basis. And it is above the longer duration rates. So yeah, really, until this comes down, there is still pressure on global risk, regardless of whatever bounce we got last week. So thank you guys for watching, and until we speak again, good hunting. All right, hello premium subscribers. Hope you guys had a great weekend. Right now, we are looking at an overvalued situation right now. S&P action is above the sell level at 2044. Buy level is all the way down at 1960 right now, and fair value at 2010 for the next 3 weeks. The price targets are continuing to drop down into a low of 1987. That's near the 1985 area. That's been contested territory for quite a while. And in terms of our fair value proximity percentile, we're still up at that 90% danger threshold, having peaked out at 98% last week. So we definitely need to be on our guard and continue to basically sell that range from 2045 up to 2100. And we're going to be buyers as we move into the 1985 area. And charting our top TSP allocations, we're seeing some conflicting signals here. Basically, our G minus S average over the last 3 days, which typically spikes up when we have value condition and we're safe to buy here, and typically leads market action to the downside. Has definitely plunged here, meaning that we're going to have some downside action for that to rally up back above zero and into a buy level. This is essentially the spread between the cash treasuries and small caps allocation. Similarly, the risk 1-day versus risk 3-day average, which leads action, has also peaked out here and plunged and has not seen a bottom yet. So those are both risk signs. However, the delta on that risk spread has come up above the zero line, which has marked some short-term lows before. So 2 of 3 signals are bearish, but it looks like downside could be constrained. The Tenkan and Kijun have inverted into a bearish phase. Ichimoku phase is also negative, and we're looking for